Hello everyone, thanks for checking out my video. I think we just saw one of the most volatile weeks in a while. So earlier last week, the stock market saw a brutal sell-off with Nasdaq suffering its worst day since 2022 and the S&P 500 entering a correction territory, which is defined as a 10% drop from its peak. This is the first correction since 2023. But then on Friday, the entire market rallied and we saw the S&P 500 clinching its best day of the year so far. Such highly volatile and rough week was a result of Trump's back and forth tariff policies. And whether we like it or not, this is going to continue for a while more. With the latest rally, investors might be wondering if this is a dead cat bounce or a resumption of the bull market. This is something that I will be covering in this video. Meanwhile, amid the volatility, I dipped my toes in once again. And if you are keen to know what I have bought, do watch to the end of this video. Okay, as mentioned, last week was probably one of the most volatile weeks we have seen in recent months. The week began with a huge meltdown on Monday as we saw one of the most brutal sell-offs since COVID days. The stock market tanked to its lowest levels in 6 months, driven by relentless tariff news from President Donald Trump and growing fears of an economic slowdown. Investors were basically dumping stocks due to the fear of US economy heading into a recession. The sell-off erased more than $4 trillion from the S&P 500's market value since its February peak. That was also the day where tech-heavy Nasdaq saw its worst day since 2022 as the Magnificent 7 stocks led the sell-off. Specifically, Tesla plummeted 15% on that day and recorded its worst day since 2020. There was so much fear in the market as according to the CNN Fear and Greed Index, the level of extreme fear was at 15, which is the second most amount of fear since 2022. Fast forward to Wednesday, the market received a cooler than expected CPI report for February, which showed inflation was slowing. As a result, the market rallied nicely on that day, but it was lacking strength. True enough, on Thursday, sellers showed up again and caused both S&P 500 and Nasdaq to close 1.4% and 2% lower respectively. With that decline, the S&P 500 was down 10.1% from its record closing high set just less than a month ago, putting the index into correction territory for the first time since October 2023. The Nasdaq was 14.2% below its record December high. Finally, Friday came and the stock market rebounded with big tech shares recovering sharply. Nvidia popped more than 5%, Tesla climbed around 4% and Meta surged close to 3%. Amazon, Microsoft, Google and Apple also jumped higher. The S&P 500 and Nasdaq actually clocked their biggest single-day percentage gain since 6 November, the day after the US presidential election. But despite the bounce on Friday, both indexes still saw a 4 weeks consecutive losses. Okay, last of all, the current market uncertainties have sent investors running from the stock market to safe haven assets such as gold, and that has lifted gold prices above the $3,000 per ounce level for the first time. Alright, I hope that has nicely summarized what happened last week. Moving on, so what's next? As we move towards the new week, there are a few catalysts that could either stabilize the market or deepen the decline. These few catalysts are the FOMC meeting, Russia-Ukraine peace talks, the ongoing trade war, and the fresh batch of economic data. There is also a bonus event to watch, which is the week-long GPU technology conference by Nvidia that will kickstart on Monday. Alright, let's first talk about the events that could move the market potentially. Well, the biggest event of the week is probably the Fed meeting that is taking place on 18 and 19 March, where the Fed will announce their rate decision and the updated economic projections. The Federal Reserve is widely expected to keep its interest rate at the current level. What investors will be laser focused on is Jerome Powell's press conference. The market will look for clues about how the central bank views the ongoing trade war in relation to inflation and the broader US economy. The Fed is in a situation where they can't ignore the tariff noise, but they also don't want to overreact to hypothetical risk. Next, investors will also be paying attention to the latest developments from the negotiations between US, Russia, Ukraine with regarding to the ongoing war. In addition, the other kind of war, the trade war, will continue to hit the headlines as we approach 2nd April, where several US tariffs are scheduled to take effect. These two wars are evolving rapidly, so you might want to keep yourself updated with the news to avoid being caught off guard by sudden market swings, whether is it up or down. In other news, there will be some economic data releasing in the new week ahead, such as the retail sales report, initial jobless claims, and existing home sales, but these are unlikely to move the market in my opinion. Last of all, we have a bonus event to watch, which is Nvidia's week-long GPU technology conference in California that starts on Monday. There is a keynote address from CEO Jensen Huang on Tuesday. Investors will likely be watching for updates on the company's latest AI chips, upcoming releases, and developments in their gaming and robotic products. Similarly, I am not expecting this event to move the broader market. At most, it may create some volatility in Nvidia's share price. Okay, let's now read some charts, starting things off with SPY, which represents the S&P 500. If you had watched my previous video, last week's market meltdown should not have caught you off guard. Because in that video I shared that if SPY breaks below that blue support line at 562, I was of the view that SPY might just grind lower towards the 10% correction territory, hitting around 552. And there you have it, SPY went even as low as 549.68. So after we had that bounce on Friday, what's next? Let me break it down in very simple terms for the viewers. Basically, watch that 200 moving average. Watch it like a hawk. If the latest rebound is a dead cat bounce, then SPY will likely face rejection at this 200 moving average, which now sits at 570. A rejection at this moving average means the bearish trend will likely continue, and the recent low may be breached. To add on, what I didn't quite like about last Friday's bounce was a lack in the volume. As you can see, the volume was lower than the days when the market sold off. However, given how fluid the current macro environment is, and if let's say we have some positive catalysts, whether is it from Trump's tariff plans, or the ongoing Russia-Ukraine war, or Powell's press conference, and somehow SPY manages to close above 200 moving average, then that's a pretty good and positive sign. That being said, I wouldn't be too excited until SPY crosses the 50% Fibonacci retracement level at around 582. That's also where I had that green line is. This green line used to be a support level, but now has turned into resistance. So if SPY can somewhat close above 582, then I would say bulls are regaining their strength. Once again, just to reiterate and emphasize, watch that 200 moving average closely. It's a critical and kind of pivotal level. Next up, let's check out Apple's chart. Among the Magnificent 7 stocks, Apple was the weakest last week as it fell around 10%. That was its worst week in about 2.5 years. I guess their shares buyback plan might have paused, and the market was coming for Apple after dumping all the other Mag 7 shares. Okay, here are two positive takeaways from the chart. Last Thursday and Friday candlesticks look like bullish harami candlestick pattern to me, though it's not the textbook version kind. This pattern is supported by an oversold RSI indicator which started to curl back up on Friday's rebound. For confirmation of this technical rebound and that candlestick pattern, the next candle should close above last Friday's candlestick, which means to close above 213.5. A close above it could give us a decent probability of testing the first Fibonacci retracement level at 218, or perhaps even enter the 220s range. Okay, but that shouldn't excite the bulls yet, because to reverse this whole downtrend, Apple needs to reclaim the 200 moving average at around 227, which is quite an uphill task from the current price point. All in all, as long as we stay below this 200 moving average, I will see Apple as bearish, which means any rebound could be met with resistance or sellers stepping in. In terms of the downside, the bulls will have to protect that green support line that I drew at around 206. We actually went pretty close to it last week, but fortunately Apple bounced back up before touching it. Anyway, where did this line come from? When I zoom out the chart, you will be able to see that there isn't much support below 206. This means losing 206, Apple will likely continue to grind below 200. This is the time that I will be excited to either pick up shares or sell put option. Moving over to Tesla's chart, which looks interesting to me. I will be watching it closely this week. The reason is because the share price has been beaten down very badly, falling about 50% from its peak. So I want to see if the latest rally is a dead cat bounce or not. By the way, I like how Tesla filled that two gaps and bounced off the moment it filled the bottom gap. Just to share, I have been talking about these two gaps for months, and therefore Tesla falling to the bottom of the gap should not come as a surprise for viewers who watch my videos. Therefore, for those who have not subscribed to my channel, do consider doing so that you can get weekly updates from me. Anyway, two key areas or levels to watch this week. The first one is the green zone that I drew, which is around 264 to 272. This area has turned from a support area into a resistance zone. So for Tesla to stop being a falling knife, it has to first reclaim this area. Next, the second area to watch is around 281 to 82 area. That's where the first Fibonacci retracement level and the 200 moving average are. If Tesla can go above this area and that green zone and supported by a bullish MACD crossover, I do think 290's range could be in sight in the near term. From there, I wouldn't even be surprised if it continues to push towards 300. By the way, from the current price of 250 to say 290, that's a 16% upside potential. But here's a but, it may not all happen this week. Just to add, if we want to see Tesla regaining its full-blown bullish momentum, I would want to see the share price reclaiming the 50 moving average, which currently sits in the 350s range. And that's a long way to go, so let's take one step at a time. On the other hand, if Tesla gets rejected by either of the two key areas that I highlighted, be very careful, because it means the decline isn't done yet. And the falling knife can keep falling. That's when I expect the recent low of 217 to be tested. Given how volatile Tesla is, breaking below 217 will likely see the share price hitting low 200s range. And from here, pay very special attention to the psychological support of 200. If that breaks, do you believe there is a decent chance for Tesla to continue to grind towards that gap there? The gap is between 147 and 157. Sounds crazy? I don't think so. But yeah, that's if 200 level breaks. Let's now hop over to Google's chart. I love how Google fell so nicely to kiss the green support zone that I drew and bounce back up. So for the new week ahead, watch that MACD. It looks like it wants to have a bullish cross, but haven't happened yet. If we do get a bullish cross, I think Google will easily fill that gap and charge towards the first Fibonacci level at 172. That particular gap is between 168 and 170, in case you wonder. But for Google to stabilize its footing, it needs to reclaim that 200 moving average at around 175 as soon as possible. I have shared this countless times in my video that this 200 moving average is very critical for Google. The longer we stay below it, the more bearish Google gets. If we somehow can get a few nice green candles above the 200 moving average, then I wouldn't be surprised if Google continues to grind higher towards the 180s range. But on the other hand, there is a scenario that the bulls will not want to see, and that is Google bounces up to test the 200 moving average and gets rejected. That's very bearish in my opinion. When that happens, we could fall from 170s range back to the 160s range again. Just to highlight, the last time when Google was below the 200 moving average for more than 2 weeks was back in 2022. Back then, Google continued to stay below the moving average for months, and it fell from 140s range to 80s range. Okay, I'm not saying it will happen this time, but I hope you get the drift. The time is ticking for Google to reclaim that 200 moving average. Let's now have a look at Meta. Well, Meta fell towards that green support zone and bounced back up. I almost wanted to step in, almost. But I didn't pull the trigger as I was waiting for a slightly lower price. Did I miss the opportunity? I don't know. Let's see what happens in the next few weeks. Anyway, for the upcoming week, watch this support zone again, which should provide some form of support. This area is between 596 and around 603. If this area gets breached, I would say the best will very likely bring the share price towards the 200 moving average. Speaking of which, Meta is the only Mag 7 stock that is trading above the 200 moving average. Let's see if this last giant will fall. If it does, I will be excited to pick up Meta shares or sell put option. As for the bullish thesis, well, obviously Meta is not out of the woods yet as it has been floating at this green support zone. To even have that bit of bullishness, Meta needs to at least climb above the first Fibonacci resistance level at 622, but that's just the first baby step. For any possibility of reversal, Meta needs to reclaim two important levels, and they are the 50 moving average at 654 as well as the 50% Fibonacci level at around 663. Seems like it's a long way to go, right? Well, one step at a time then. Just to add, any rejection at those resistance levels that I have just mentioned means the bearish trend is going to continue. Alright, moving on, let's now look at Microsoft's chart, which looks straightforward to me. If you have been following me, you will know that this 385 is a key level for Microsoft. We lost this level last week, but also regained it in the same week. And if you were to look at the chart closely over the last 6 trading days, on each and every day, Microsoft touched this 385 level. This simply shows how both the bulls and the bears are trying to stake a claim at this level. Okay, here's a potential positive news for the bulls. Note the word potential. It's the MACD. The MACD seems like it's about to have a bullish cross, so watch it closely this week. If the bullish cross happens this week, we can expect Microsoft to test the green line at around 396. And if we can close above 396, then I think it's kind of obvious that Microsoft could see 400s range again. But to be honest with you, any pop or bounce at this moment will not get me excited, unless Microsoft can start closing above the 50 moving average or the 200 moving average, which are 411 and 422. That's a long way to go, man. Just to add, ever since we had that death cross, which is defined as the 50 moving average crossing below the 200 moving average, Microsoft has been pretty bearish. The 385 level seems to be the last line of defense that the bulls are holding on to. And the worst case scenario for the bulls is that Microsoft has that bullish cross on MACD, bounces up, trap the bulls, and then get rejected at either of the resistance levels and fall below 385. Alright, moving over to Nvidia. For Nvidia, there are a few important things to take note of. First up, let's start with the bullish stuff, and that is the MACD. Just like a few other stocks that I covered, the MACD seems to be on the verge of crossing up. If we have a bullish cross this week, I would expect Nvidia to go above the 50% Fibonacci level at 124. I know I have shared before that usually if the share price can retrace past the 50% Fibonacci level, it's a signal for a potential reversal in trend. So by that logic, going above 124 this week, does it mean that the downtrend for Nvidia is over? Okay, not quite so. Reason being, okay, sorry, just a very quick one. If you wish to support this channel and are also looking for a new low-cost brokerage, do consider Longbridge. Because to be honest, I will earn some referral fees if you sign up using my referral link and deposit at least 2,000 Singapore dollars. If you want to earn a free Nvidia share, you will have to maintain that $2,000 for 30 days and make 3 separate buy trades. Check out their website for more information. Alright, back to business. Just to clarify, going above 50% Fibonacci level only increases the chance of a reversal. It's not a guarantee. In fact, nothing is guaranteed in the world of investing. So, above 124, there is a special area that you need to watch like a hawk, which is between 127 and 129. This is an area where the 200 moving average, 50 moving average, and the critical 61.8 Fibonacci level are. I am of the view that Nvidia is very likely to face heavy resistance in this area if the macro factors don't improve, and a rejection at this level will likely see us going below 124 again. But let's say if Nvidia can close above this 127 to 129 area, it's pretty bullish, because that leaves us with one final obstacle, which is the purple downtrend line. Bulls need to bring the share price above it then we can say Nvidia has regained its full-blown bullish momentum. Well, sounds like a lot of obstacles along the way, right? It certainly is. Just like Microsoft, I am just afraid that we could see a MACD bullish cross, a bounce up to trap the bulls before the next dump. And oh, just one more thing. Earlier on, I mentioned that Microsoft had a death cross on the chart, and it is the only Mac 7 stock to have that at the moment. Well, it seems like the death cross is coming for Nvidia. I know some may argue that death cross or moving average is a lagging indicator, but the last I checked, typically when the death cross happens, the share price remains beaten down for a while. And the last time Nvidia had a death cross on the chart, the share price plunged 50%. Okay, I'm not saying it will happen this time, I am merely reading off the chart and sharing what I know. Please don't shoot the messenger. In fact, if you like Nvidia at 140s range, you should like it even more at 100s or lower. Moving over to the options trading segment, just 2 new trades to update this week. As usual, I have summarized them on the screen. The first trade is this new cash secure put on Nvidia, which was sold on 10 March last Monday with $90 strike price. The contract will expire on 17 April. A quick recap, what happened on that day was called a bloodbath. The market was selling off massively, with Nasdaq suffering its worst day since 2022. The sell-off was intensified that day because investors were worried that Trump's tariff policy uncertainty would bring US economy into a recession. The fear and greed index fell to 14 extreme fear, its lowest level since the 2022 bear market. Typically, when the market is so oversold and with extreme fear in the market, a short-term technical rebound tends to happen soon. That was why I quickly stepped in to sell a put option on Nvidia, which is a bullish move. Furthermore, I choose a strike price that I am pretty comfortable to buy Nvidia shares at, which is $90. Anyway, Nvidia really rebounded and closed much higher by the end of last week. With that, this trade is now sitting on a paper gain of about 71%. The second trade to update is this new cash secure put on Tesla, which was sold on 12 March Wednesday with a strike price of $140. The contract will expire on 25th April. The reason why I stepped in was because Tesla was very oversold at the start of the week. It all started with Monday 11 March. There was a 15% sell-off in Tesla shares and its RSI hit the most oversold level in over a year. Theoretically speaking, just like Nvidia, a short-term rebound should likely happen. But I decided to hold off my trade because Tesla has been a falling knife since Trump took office. And so I waited for 2 more days for confirmation. So the next day, Tesla closed green. Then on Wednesday, CPI came in soft and the market rallied. That was when I stepped in. Well, by the end of last week, Tesla has seemed to stop its rot for a while, although it is still lacking strength to climb higher. Nevertheless, my trade is currently up by around 32%. Moving on to the last part of the video, quite a fair bit of thoughts to share about the current market. First of all, clearly the market doesn't like all this tariff stuff. Things are just too fluid at the moment and are changing too rapidly. This creates a lot of uncertainties in the market, which is why many investors chose to err on the safer side by dumping shares to either keep some cash or move to safe haven assets. This is also why it took less than 3 weeks for S&P 500 to fall into a correction zone, and this is one of the fastest corrections on record and the fastest peak to correction decline since March 2020 during the pandemic period. So the question now is, what happens to the stock market next? Okay, according to Dow Jones market data, the history shows that since 2008, stocks have typically declined in the first month after the S&P 500 entered correction territory, giving an average negative return of 1.7%. However, the stock market tended to rebound over longer time frames, with the S&P 500 gaining an average 2.1% over the next 3 months and about 5% over the next 6 months. But of course, there are some caveats to this. First, that's if history is of any indication. Second, it also depends on whether the decline turns into a larger bear market. I mean, look at 2008 global financial crisis and 2022 extremely high interest rate environment. the market continued to decline in the next 3, 6 and 12 months after the initial correction. Alright, after looking at this table, some might ask what should we expect this time? Honestly, no one knows, not even the biggest bull Tom Lee, who said that the market could be bottoming on the week beginning 3rd March, but the market went further down to enter the correction zone. The reason why it's difficult to predict where the market is headed from here is because we don't know what Trump wants. Some investors believe Trump is using the tariff plans to negotiate things that he wants and expect him to pull back on some policies before they become too damaging, while others say that the uncertainty alone is creating enough pain in the stock market. Anyway, here's my take. On paper, investors can lose a lot of their money. There could be huge drawdowns in our portfolios, something like this that I experienced last Monday. I'm sharing this screenshot to highlight that my portfolio isn't immune to downturns or Trump tariff-related shocks. More importantly, I don't want to show viewers only the gains and rosy stuff of my portfolio. Another point, or in fact the main point that I want to make, is that in almost every case, investors would have made back all their losses from a downturn from US stocks. If, a big if, they hold on to fundamentally strong companies through corrections and bear markets, which includes the 2000 dot-com bust, the 2008 financial crisis, and the 2020 pandemic meltdown, and many other crashes. Last of all, to answer the questions at the very start, is this latest rally a dead cat bounce or a resumption of the bull market? Well, in case you skip the technical analysis segment, my view is that it depends on whether the S&P 500 index can reclaim its 200 moving average or not in the next few weeks. My personal view is that the current bounce means nothing because things were already lining up for this bounce, which I did share in my last video. Mainly because there is too much negativity built among investors, as shown by the Fear and Greed Index, and also simply because the market doesn't move in one direction forever. Furthermore, we went down 10% from all-time highs in one of the fastest fashions, and indicators were screaming oversold. All this have set a good condition for a relief rally. Honestly, I don't see a catalyst that would spark any huge reversal at the moment. But does this mean I'm bearish? Well, in a way, yes, I am cautious and bearish in the short term as I await to see what Trump has in store for everyone in the next few weeks, or at least till April. Another reason for being cautious and bearish about last Friday's bounce is that the rally was supported by a relatively low volume as compared to the sell-off in the previous weeks. Okay, but just to note and clarify, that's my sentiment for the next 3 to 4 weeks. I am still of the view that the overall bull market is still intact due to the current strength of the economy and positive data from the jobs and inflation reports. I will turn full bearish if these fundamentals change, and technical wise, if S&P 500 gets rejected by the 200 moving average and continue to trade below it for the next few weeks. Finally, before I forgot, as the market entered the correction zone last week, how could I not step in, right? So I dipped my toes in for Google again, and I also bought the S&P 500 index. Okay, in case you go wondering, since I'm leaning towards bearish and cautious mode, why did I still step in? The reason is simple. What if I'm wrong? I mean, Trump is unpredictable. What if things turn around? What if both the Ukraine, Russia and trade wars come to an end quicker than we thought? Sentiment could change overnight. And just to note, I only went in a little bit, just a tiny bit to get my feet wet. This is just in case the current rally is a dead cat bounce and more downside to come. If that happens, then I will deploy more money into the market. Alright, that's quite a bit of sharing on my thoughts, but I think I have to do it, especially in chaotic moments like this. Anyway, long-term investors, don't panic and stay calm, alright? So long as we hold on to fundamentally strong companies, our portfolio should turn out fine eventually. That's all for this video. Do remember to help tap the like button if you found my video useful. Thank you very much.